Welcome to the topic on access to credit. Why is credit important for business growth? Credit is very important for growing a business. It has the following benefits. Empowerment. Credit access helps women grow their businesses, invest in new tools or resources, and bring in new ideas. This improves their ability to run a business and helps it grow. Economic aspect. Giving women credit also helps create more jobs, supports community development, and reduces poverty, which boosts the economy. Now let's learn about Meera, the story of a conservative entrepreneur. Meera is a tailor from a small village. She started her business with 20,000 rupees she had saved from self-help group activities. As her number of customers grew, she couldn't invest in new sewing machines or raw materials because she didn't have enough money. Her business slowed down, and she started struggling to manage household expenses. She began living from one paycheck to the next. Meera's dream of expanding her tailor shop remained unfulfilled. Now let's take the example of Anita, a woman who takes risks. Anita starts a tailoring business with 20,000 rupees. She saw good demand in the local market and decided to borrow 50,000 rupees. She took the loan from a local money lender at a high interest rate. Due to ups and downs in the market and a sudden drop in demand, she had to sell her gold to repay the money lender. Anita's financial situation got worse, and she ended up back where she started. Now let's understand through Kamla's example, who is a smart planner. Kamla started a tailoring business with 20,000 rupees. She attended an SRLM workshop and learned about government schemes that give loans at low interest rates without needing any collateral. Kamla took a 50,000 rupee loan under the Mudra scheme through a government bank. She bought better sewing machines, purchased raw materials in bulk, and promoted her business at local fairs. Within a year, her income doubled, and she repaid the loan on time. Because of her good repayment record, Kamla became eligible for a second, bigger loan. Now let's look at the challenges women face in getting loans. Lack of awareness. They don't know about the schemes or how to access them. No formal credit history. Hesitation in taking business loans. Not having enough documents. Lack of financial knowledge. Dependence on male family members. Lenders see them as risks. Financial institutions may hesitate to give loans because of lack of security or seeing small businesses as risky. What is a loan? A loan is money you borrow from someone to meet your needs. You have to pay it back with interest. The interest is usually decided by the person or organization giving the loan based on conditions like the time period, etc. Let's see why people need to borrow money. We borrow money for many reasons such as buying a house, buying a car, starting a new business, paying for education. Loans are of different types and are given based on the need. The main types are business loans and retail loans. Business loans include group loans, personal loans, secured loans. For these, you need to give some asset as a guarantee. Another type of business loan is unsecured loans. For these, you don't need to give any asset as a guarantee. Retail loans are loans given to individuals for their personal needs. These include loans for marriage, medical loan, travel loan, house loan, car loan, education loan. What are secured personal loans? These loans require you to give something valuable like land, property, or gold as security for the loan. In most cases, the value of the item you give is used to decide how much loan you can get. These loans are helpful for people who don't have a strong credit score or don't have regular income. Unsecured personal loans. You don't need to give any valuable item as security. These loans are given based on your credit rating, your bank account, income, or your ability to repay the loan. In case of medical emergencies, home renovation, wedding expenses, or any other personal need, unsecured loans can help by giving you money. Here is some basic information about loans. Interest rate. This is the percentage charged on the loan by the lender. It can be fixed or floating. Loan tenure. A loan has a set tenure, time period in which the borrower must repay it. In some cases, a moratorium is given, which means the borrower doesn't have to pay EMIs for a short time. Term can be between 6 to 84 months. Type of loan. Loans can be of different types like lump sum, one-time full amount, or CC limit, cash credit. Margin money. This is the part of the total loan amount that the borrower pays from their own side. It usually ranges from 5% to 25%. EMI. This is the monthly repayment amount. That includes both the main loan amount and interest. Extra costs. These are extra charges taken by the lender, either once or yearly. Now let's learn about the main documents needed to get a loan. Main documents required for a loan are Aadhaar card, PAN card, Voter ID, Udyog Aadhaar. In addition, a few more documents are also needed, such as Business Registration Certificate, Proof of Address, any one, like Electricity Bill, Ration Card, Financial documents required for a loan, Bank statements for 6 to 24 months, Income and expense records, GST registration, if applicable, Financial reports audited by a CA if needed, Business plan. Other requirements. Credit history should have no defaults, regular repayments, and even new credit is acceptable. Security could be a fixed deposit, FD, or any physical asset that can be pledged. Thank you.